Welcome to another episode of Risk Spotlight's weekly operational risk news update. I am Emily Jones, and I will be sharing insights on key operational risk news updates from last week. These updates are based on content from the Risk Spotlight portal, which is the world's first forward-looking operational risk content service. The first update is about the alarming rise in synthetic business fraud, where fraudsters are creating fake business entities to exploit the system and secure large business loans. Experts say this type of fraud has grown by 150% in the past year, and it's estimated to be causing between $1 billion to $3 billion in annual losses. The problem is getting worse, not just in the US, but globally. In the UK, the government's Companies House agency adds about 4,000 new companies every day, and around 800 of those are fake, more than double the number from a couple of years ago. This is happening because financial institutions have focused their fraud defenses on the consumer side, leaving the commercial side exposed. The data and verification processes around businesses are much weaker than for individual consumers, making it easier for fraudsters to create synthetic business entities. With the shift to digital company registration during the pandemic, the process has become even faster and more frictionless, overwhelming the agencies that are not equipped to thoroughly verify all the new businesses. The next update involves warning by IMF highlighting that cyber attacks could trigger bank runs, as incidents at financial institutions could undermine trust and lead to market sell-offs or runs on banks. The risk of significant financial losses from cyber incidents has increased dramatically, with losses potentially causing funding problems for companies and even jeopardizing their solvency. The IMF states that the size of these extreme losses has more than quadrupled since 2017 to $2.5 billion. And indirect losses like reputational damage or security upgrades are substantially higher. Cyber attacks on financial firms now account for nearly a fifth of all attempted hacks, with commercial banks being the most exposed. The next update highlights that the first 3 months of 2024 saw a significant surge in data breaches in the U.S., with 841 publicly reported incidents, a 90% increase compared to the same period last year. However, the total number of victims decreased by 72% annually to 72.5 million, and 81% from the previous quarter. Cyber attacks were the main cause of these incidents, accounting for 642 breaches and 28.3 million victims. System and human error were blamed for 85 incidents and around 181,000 victims. Supply chain attacks continue to be a major challenge, with the number of companies impacted more than tripling in Q1 2024 versus the same period in 2023. The financial services industry was the hardest hit in terms of overall data breaches, followed by healthcare and professional services. Financial services breach notices tripled year-on-year to 224. The next update involves increased focus of regulators like the FDIC on the downstream risks associated with third-party relationships. They're recommending that companies ensure board and management involvement in the life cycle of these partnerships and maintain thorough documentation of due diligence. 65% of banks and credit unions have entered into at least one fintech partnership in the past 3 years, with 76% viewing these partnerships as necessary to meet customer expectations. And 95% of banks are focused on using partnerships to enhance their digital product offerings. However, if third-party partners fail to align with the company's goals, vision, and values, it can hinder progress and lead to wasted resources. As business operations become more digitized, companies also risk data breaches and regulatory violations if they don't adequately protect sensitive information shared with partners. The next update is from Canada's financial crimes watchdog, FinTrack. It recently released an internal report that paints a concerning picture of anti-money laundering compliance in the country. The report found that only 106 out of 237 financial institutions were compliant with the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. That means over half of the institutions examined were failing to meet the legal requirements. The report looked at different sectors. For banks, 78% had incomplete or absent anti-money laundering policies. For money service businesses, 84% had incomplete or non existent processes to detect dirty money. Canada also has an upcoming evaluation by the global money laundering watchdog, the Financial Action Task Force. Poor compliance ratings from them could lead to economic sanctions. So there's a lot of pressure on Canada to crack down on these issues before their next review. The next update involves increasing crackdown by SEC on insider trading and off-channel communications as more people work from home in the post-pandemic era. They've brought charges against several individuals who allegedly traded on material non-public information, MNPI, they obtained from their spouses or partners while working remotely. The SEC is using sophisticated data analytics to detect these potential insider trading violations more quickly. They've also been aggressively enforcing rules around off-channel communications, bringing multi-million-dollar settlements against firms like HSBC and Scotia Capital for failing to maintain and preserve records of these communications. Companies and individuals need to be very careful to protect MNPI and ensure all business communications are properly recorded, especially with the rise of remote and hybrid work. Employees should take steps like using headphones, privacy screens, and strong passwords when working from home. Companies also need robust policies governing MNPI and personal device usage, and they should provide thorough training to all employees, including senior staff. And there you have it, a whirlwind tour of last week's operational risk landscape. If you want to read more about the topics I have covered and review additional content on emerging operational risk topics, then please log in to the Risk Spotlight portal if you are a subscriber, or go to RiskSpotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.